Hey, welcome, we're back. We are back and live after a nice break. Been away, traveling over to Asia and stuff and everything, and but we're back. Live scalping. We've been scalping in the background, but we're going to be back doing more live streams, and obviously today is an important one. We're back on NFP. So thank you everybody for joining, and I'm sorry we've been away so long, but yeah, it's all good. We are back and we're looking forward to trading gold today and US 30 on NFP. We've had a good session this morning as stocks were dropping due to all the misses on the earnings report, and so now we're looking to see what NFP is going to deliver. Obviously go to the website www.mohawkforex.com if you want information on how to get involved in the mentorship, and me and the team guide you in the art of true scalping, which is a totally different way of trading to most people I've seen out there. Yeah, high risk but high reward, quick in and out, don't overstay our welcome in the market. We trade predominantly gold, US 30, DAX, the NASDAQ, cable. They're our main choices. We get requests to trade other things which we can do, but they're the main things we stick with on a daily basis, 5 days a week. So yeah, coming to you from London today, and some of our team are based over in America as well, and obviously I'll be moving over to Asia in the next few months where I'll be live from over there. So yeah, let's have a look. We've got literally about 20 odd minutes to go. We've got our chart set up on gold. We're looking at a 5-minute time frame. As you can see, we've had some areas of support and resistance that price is looking to break out from on the news. We've set our levels of potential take profits and potential areas of reversals. So if we miss the initial move, which most of the time you do because it moves before the news comes out, cheeky little manipulation to catch all you people out with your pending orders. If you ever try that, then don't, because you'll blow your account. And so these are areas here we can either join in on the push up or down, and we can catch the reversal as price usually goes up to these levels and will retrace back down to around where it started before the US Open and then take off again. So at the moment we're in kind of neutral territory. As you can see, our RSI and our bigger time frame MACDs coming down from a buy kind of level, but it's got no relevance really to what happens with NFP. We know that. And NFP, more focus today is going to be on the actual earnings, because even though the payrolls might have dropped to the lowest figure of only 185,000 jobs, it's the earnings are still staying fairly high, 4.3, 0.3 on the month, and could it go a little bit higher, which obviously means inflation is still the concern for the Fed, and tightening and interest rate rises might still occur. So obviously this could affect gold and the stocks. Could affect gold positively, could affect it negatively. You never can tell, because we've had reports where it's been better than expected, gold goes up. We've had better than expected and gold goes down. So you can't just look back, unfortunately, with these kind of events. You can have a sense of an idea, but with all the manipulation that's around and with the spreads that are given by brokers, you've really got to just wait for the result and don't get no FOMO, don't anticipate, don't predict. Just let the move happen, and then either try and get in on the move if your broker will execute the trades, or wait for the pullbacks to occur, as they always do. There's always a wick down, there's always a pullback before continuation. And that's true scalping. That's what we do. We do a lot of reverse trading, a lot of reversals we catch, and we use our 1-minute setup, which is here, look. That's the same 5-minute channel chart there, look, as you can see, but we just have a 1 minute at the side just to watch and try and catch reversals, or where price might go to an extreme kind of limit before it pulls back, which I'm thinking, like you say, is about just underneath that level of resistance there, and probably about here we've got a heavy support zone. That's usually like a 4 hour support zone. So we're talking there's a potential here for a move of up to 100 pips on gold, possibly either way, depending on how strong the news result is, how close or far away it is from that predicted figure of 185 and what the earnings do. So, you know, if they get it bang on, you won't get such a big move. If it's way higher, way lower, then usually we will get a move in the markets. So that's kind of our levels set up, and I'm just going to log into my broker, which is IC Markets, as most of you know. I'm just going to set some potential levels to take me out of the trade at a reasonable level on this. And you don't want to be too greedy. We're going to do multiple trades, so I'm probably going to set about 20 pips per trade. So look, you know, if it just spikes up to there, I'm going to get a winner. If it spikes down to there, I'm going to get a winner, whichever way. And then I'll just wait for the pullbacks from this zone. The 1 minute, I really, on NFP, you don't want to focus on the 1 minute. It'll just blow your mind. I really just use this to see where the extremes are in the bands and where the potential pullback might come. But you can do that all pretty much on the 5 minute chart. You don't want to be looking at too many multiple time frames. You'll just confuse the hell out of you. We've got our KG baseline, you know, again, but none of this is relevant to when we get to the news event. As you know, that it can do absolutely anything. You just got to look at the next levels of support and resistance, wait for the move, join in, get the green and get out, and don't try and hold, and don't panic either, you know. What goes up must come down, and it usually does on NFP. We can scroll and see where our levels are. You can see that's that level we've got here, look, and where gold was right up here. Now the chances of gold just shooting all the way back up to here today is very slim. You know, it's got to break this neutral resistance, which again is like a 4-hour resistance. So it depends on the result. So again, stop loss wise, my stop losses are going to be kind of either side of the heavy support or that neutral resistance. That's how you want to be doing it, and then adjusting your lot sizes accordingly for your risk management, of course. But we're trying not to mess with that. We're trying to get in and out within this kind of zone of 200 points, 20 pips or so, and getting our green and getting out, and then waiting for the US Open. So we'll stay live with everybody until then, of course, and we can see what we try and get. So I'm looking at a 0.3 lot size, which is 30 cents per pip, 24 pence for those in the UK. So nothing crazy, you know. A margin's only going to be about $100 per trade, so I'm not going hell for leather on Lambos and crazy stuff like that, because I want to be able to enter multiple trades, and also if I get it wrong or it goes against me, I need to have enough in the tank to average down my trades, so that I either minimize my loss or come back into profit. If you stick all your eggs in one basket in one big trade and hope you've got the direction right, yes, great if it goes, but if it goes against you, you're stuffed and you're going to get margin call and stopped out. So it's better to go smaller lot sizes, multiple trades, and leave yourself enough room, like I say, to bail yourself out of a position and try and win back any losses, which obviously we want to try and avoid, but they do happen, of course. Got coffee on the go, and we've got Bloomberg plugged in as well. Obviously that news there about Apple and tech is what crashed NAS. You can see here we've got another chart set up, and we'll just have a quick look at NAS. It's actually pulled back. We caught this buy here. There was the open. We had a few trades on that this morning. You can see we're coming up to a minor resistance level here. That's a 200 moving average, nothing special, just to give you an idea of where the bigger trend is. You can see it kind of spent most of the week, you know, they're saying it's been the high, it's come back off those highs, pulled back, and now is retracing again. You can see here, look, we're kind of a double top. It's pulled back, and we're going to break this resistance on the NFP. who knows. We've got our momentum indicator here, volume as well. I've got a TDI set up. Again, nothing special. We use the indicators just to back up our price action analysis, to be honest with you. And for me, let me know when prices are potentially reached an extreme and I've got a chance of pulling back. I've got a resistance zone now, look, as you can see, forming our blue zone. But again, this is no indication for NFP, because NFP can take NAS right up to that 1300 level or drop it back down to that 12437. So there's plenty of movement there if you want to trade NAS. I'm going to stick on gold and also try and get it on US 30. What I might do is go gold on this and then US 30 on the open, just to see whichever moves the most. Sometimes gold has the biggest move, sometimes it doesn't, and it's outdone by the US 30. But obviously US 30, you need more margin, more leverage to trade it and to be able to have those multiple trades that you need. So we will just stick on gold. So that's my kind of predicted level. I've got 15 minutes to go. I'm just going to take that yellow line off so you guys can see where we're at. But yeah, I'm expecting a decent move up to these kind of levels. It doesn't necessarily have to reach those levels. If it breaks this level here, then we're up to this neutral resistance. We've got the biggest, the best support and resistance levels here, which are kind of like the big 4-hour ones. But whether we get a spike that big, I doubt it. Who knows?
What we ended up having is a disconnect between J Powell and labor market is still
in the background.
And I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to targets.
The fantastic Wei Li, the global chief investment strategist over at BlackRock. We are 14 minutes away from a jobs report in America. The median estimate in our survey, 189,000. And take a look at markets, just erasing some of the losses.
189,000.
Still down by 0.4%, but well off the lows. In the bond market, yields not
Happy NFP day.
Hi bro, you're right.
What's up, bro?
Happy NFP day. Nice win there on US 100.
Oh no, it's still going.
I've never traded that. I've never done that one.
That's NAS.
Oh god, yes, sorry. It's still, yeah. It's called different on my broker. It's called US Tech on. I see. So you caught that bar? You caught that bar I just showed?
Yep. Remember whenever I was telling you earlier, I want to see how it acts around the 200?
Yeah.
As soon as it retested, I popped in.
Yeah, that was a nice win. Because when it started this morning, it was down here. It dropped into, this is all that manipulation. This is all that earnings report. Euro Open was here. Look, it broke that resistant, dropped, and then obviously here we had a good cross on the old TDI and a push up. So this is where you could have entered, I suppose, just to get out before the 200, but you got in there nicely on that cross.
Yep.
Or here you could have entered there 2, 3, 4 times. I was at the gym, I missed it. Typical.
Yeah, I mean, you can. That's what I was telling you yesterday. Whenever it comes from that bottom side, it's inside that volatility band, and it goes up. And whenever your middleman starts sloping up, it's money. But then, I mean, you see, whenever we got above that 50s, whenever it came back and it retested,
yeah,
and that's a change of character, and boom, there we go.
Yeah, once that center line goes above the 50, that's it. Yeah.
Yes, sir. Yeah, I was looking for the buy because I knew it was coming, and I got caught out on a couple of them, but I just waited, recouped.
Yeah, well, I recouped off DAX because remember I went the wrong way, so I recouped on DAX. Well, we should have traded NAS. NAS was so weird this morning, and obviously again it was almost the same as NAS, and I should have gone with NAS because it looked the better setup when it was at the bands here, but it did the same thing. It just came down, it crossed here outside, so I thought there's your buy. Nope. It crossed here again. Nope. And then obviously it didn't cross until here, so this was like, is it actually going to cross this time? And like you say, you just have to wait for the momentum to catch up here and then that's where you could have gone in. Once that went green, I did hold on DAX, which is exactly the same. I got out about here on DAX and won back most of my losses, but I should have held because it was all green. It took some time to get green, and I should have just then held it, and then look, I would have been, you know, but hey, there you go. Hindsight's great, you know. Look, DAX is the same. It's just about to smack against that 200. Look, that's where I got in after I loaded all my losses. I you know, went the wrong way here, and then that was my bad anticipating. Again, it wasn't the fault of the strategy or anything, it was me. So that I should have held that all the way until you say, I think I got out here, I got out there, and then I should have waited, and then when it broke here I should have gone again. But now it's at resistance now, though. You see, look, it's coming back. It's going to cross and probably be a sell. Look, it's going to retest that.
Yeah, the only thing different from back testing this morning is whenever we had volume enter the market, just judging based on price action, it went for a stop hunt.
Yeah.
And that's a stronger move to the downside than I've seen coming out of that window, and it started a little bit earlier than it normally does. And if I'd have just waited, I wouldn't have got stopped out on a couple of them. But you know, it did exactly what it was supposed to do. But to be fair, whenever it's made these explosive moves first thing in the morning, it's usually already above or below the 200, and you can kind of anticipate it, especially whenever it drags that 20 over the 200. That's usually your directional sentiment for the day. But yeah, still back test is still running low lots on it, but it's really coming together.
Yeah.
Yeah, I think the composition of growth will improve.
It's looking good. I say we're just about 7-8 minutes away, aren't we, from it?
I mean, you can make a case, I think, for
Yes,
some
sir.
to inflation. I mean, as an example, used car prices are probably.
Oh, what's the old Bloomberg saying about NFP this morning? I haven't been on. I just had to pull over and take a quick little nap. That way I can keep going.
They're saying 1.8, 1.89.
They're stepping back. They're signaling that closer to the end. So, you know, I think the issue for market
predicted, so it just depends. We want it to be. It's nice if it would be higher, because I think gold might pop up then if it's higher. And it all depends on the wages as well, the average wages, the wage earnings that they're waiting for.
Short circuit any of that, and so that kind of, I think, puts a a bit of momentum behind risk appetite here.
Neil, 8 minutes away from the number.
Yeah,
Wrap it up there.
it's early this month, so we're combating earnings releases and NFP. I like it whenever it's a little bit later and we don't have earnings in the way of NFP.
Yeah.
I think that there's some upside risk to the print. I mean, I do
Like whenever the first Friday falls a little bit later in the month, and we're already through earnings. It's usually a lot better that way. But hey, we'll take what we can get.
Few months, because obviously it's been going down. I do think that manufacturing activity is likely bottoming out, if not picking up somewhat in the first quarter. So I'd be keeping an eye on the manufacturing work week.
I'm still holding on that buy.
Interesting.
So you're holding during NFP?
Yeah.
7 minutes away. What takes your fancy? What are you focused on?
Good lad.
Well, a couple things we need to keep it in mind.
Like I say, you can see here, look on gold, that it's dropped below, just gone below the 50, so you just don't know. You know, it's ranging around now, and then we've got the buy and sell signals. I'm going to take those out because they will just confuse. You'll get false signals on it, but I think my levels are set right there. Look, I think, like you say, we've got a. Let's go to that one. This is where we could pop up to. We might even go as high as that 1933. You just don't know. Could be a big spike up to here, then a pullback, a spike again, a pullback, and then it'll go higher, and then it'll slowly come down, 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 all the way back down before the open. Get to about almost about here, and then probably dip down to catch everybody out, and then go back up again. You know, I'm not saying I'm right, I'm just saying that's the patterns you see all the time, and then vice versa on the sell. You just got to know how many times to get in on the pullback before you get caught out. You don't want to do it too many times, because eventually price will bang up and fill. But But whenever I see a full candle,
We've heard a number
you know, then don't enter on a wick exposed, wait till the candle's full, and then bang, 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 the trade's in. Let it wick down, get your profit, get out, wait for the next one. You know, just don't ever enter when the wick's been exposed. You want to be in that. That's the technique to do it.
Wages pushing up incomes. We saw for many years growth in the 200,000s range every month and no inflation. So it doesn't really matter so much the size as whether people are paying up to get those workers. Now, how many workers do we need as a replacement level? 100,000 was sort of the view for a long time, but now David Wilcox, our head of U.S. economics, says 30,000 is all we need because the labor force has shrunk. So you got a long way to go before you'd run into any kind of issue.
And Zentner was touching on some of that, Tom. Just the structure.
But I've never heard
Yeah, Nas is sitting up at a 15-minute, a 4-hour resistance from yesterday.
The jobs number just around the corner, Lisa, 189,000. The median estimate.
So keep an eye out for weather because ADP said their number was bad because of bad weather.
So we'll see what she does.
Look out for the weather. It's going to get real cold.
It is cold outside.
Thank you. We have this argument every single winter, where Tom just goes, it's not cold.
We've got 4 minutes to go. Let's have a look at what US 30 is doing. Pretty much similar thing, a lot ranging around.
Every single winter. Your jobs report
See there, all these indicators mean nothing on NFP. We'll just take this line out. Get ready for a big move. Let's make sure my broker's logged in. I'm in. So we're going to drop to, someone's saying here, 181888. Drop on gold. Just don't know. US 30 looks pretty tasty for a bounce down, but like I say, I want to get in on gold and see. We'll see the move before the news comes out. It's irrelevant almost looking at the result because you'll miss it. You need to be just watching the chart when it gets down to a countdown of 10 seconds. When it gets to 10 seconds, you'll see it move, and then you make the decision which way you're going to go on it. But I mean, all this look, it lures you into a false sense of security. It's going to drop. Look. I've seen so many people do that and go, oh yeah, it's going to drop, look. And then guess what'll happen?
Loan account.
Well, the spreads will be crazy, but the spreads, it'll get eaten up by all this. If this move is you know, big enough to eat any spreads, so you've just got to try and click as many times as you can to get your trades executed. You know, and like I say, just don't panic, because what goes up comes down, and what goes down comes up. You know, when it's to do with NFP. It just can be a slowed ride back, but so good luck everybody. We're on the countdown. We've got 1 minute 20 seconds left. Like I say, RSI is where it should be in the central, so it can pretty much pop anywhere. Minute to go.
Seeds typically
All right.
start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. You know, we've been funding the CG system for 20 years now. It's
Right.
about $1 billion a year.
Good luck everybody.
About adaptation.
What have we got?
To go.
Everything will be funded.
30 seconds to go.
There won't be anything close to the impact of
Bloomberg's not doing anything.
climate-related maize, rice, wheat, sorghum, millet.
Get ready for that move.
Because of human genetics, we know how to do the editing.
20 seconds. Watch it move. You watch it move before the result comes out. 13 seconds.
So there's huge advance in terms
Yeah, everybody's anticipating it's going to move it.
of ecosystem moves at
People are popping in orders.
Yeah, don't do that. Well, good luck. Let's see what it move.
Lisa, you've got to explain this one to me. What does it mean when the White
Oh
House
yes, look at that drop.
markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. What does it mean
Drop on that.
Yeah.
It means they have a Bloomberg.
Wait for that pullback.
Payroll seconds away, 20 seconds away. Equity futures going into it lower by 0.5% on the S&P 500 after a monster rally to start the year. In the bond market, your 2-year unchanged, a little north of 4% at around 4.1%. Your 10-year yields coming a basis point. Your 10-year right now 3.38. With the jobs report,
Beautiful buyers back.
alongside us is Mike McKee.
Call some buys there.
Well, good morning, John. We're just waiting for the numbers to drop here. They're starting to come out. The unemployment rate falls to 3.4%. And I'm saying, oh my goodness, because look at the jobs created.
Yeah, look at that.
17,000 jobs. I don't think there was a weather effect there, and this kind of doesn't make 80.
Yeah, look at that. It's really gone.
17,000 jobs created. Private payrolls up 443,000. 19,000 manufacturing jobs. So those who were looking at the ISM reports and thinking that the manufacturing was shriveling and dying, not happening. As I mentioned, unemployment goes to 3.4% from 3.5%.
Excellent. Let's see. It's on heavy support. Look, let's see that.
Average hourly earnings come in as expected, 4.3, which drops it the rate to 4.4%. There's a base effect in there, and maybe some rounding on a 3-digit number because the expectation was for
RSI at 12. Look at that. Beautiful.
Progress. Average weekly hours 34.7. That's a major jump for that category from 34.3. Labor force participation rate 62.4%. It was 62.3%. So
$50,
major
$100
gains here on the employment side, and I guess we'll have to
wait for that to pull up.
to get to Neil Dutta because he's running around his room, opening champagne and jumping up and down. But this is a shockingly good report because we see a big gain in jobs without a big gain in earnings.
Post that.
That's going to matter to the Fed.
Neil said there was upside risk. I'm not sure he meant that much. 517,000
anybody did.
in the jobs report. Unemployment 3.4%. Wages a little higher than anticipated year over year, in line month over month. But wow, what a move. And look at the move in the market. Equity futures down on the S&P by 1% on the S&P 500. The moves in the bond market, you can guess the moves in the bond market. Yields higher by 9 or 10 basis points right the way through the front of the curve. The 2-year up by 10 basis points to about 420 now. On a 10-year yield, we are higher by 7 or 8 basis poits to 347.
So on that support, look.
In the FX market, I think you can take a guess as well. Euro dollar negative, a break of 109. Tom, 108.71, down a third of 1%. That is
that
what
curl back.
a blowout jobs report.
Off the headline numbers, I take that statistic 517,000. I add the 1-month revision. There's 2-month revisions as well, and it's a small number.
Gonna do a revision.
I want to go to you before Neil Dutta. And my basic idea is, I know you've never seen this before.
Yeah, that way they can fix where they messed up.
Numbers because of pandemic dynamics and the end of the year moving around, or is the shock of these numbers, is it 98.285% of us got this wrong?
Well, I think probably the latter, in the sense that we don't know exactly why we all got this wrong and why the number is so much bigger than anticipated. Because we're talking the establishment survey. We knew that the household survey would be disrupted in terms of employment because of the changes to the population control numbers, but the establishment survey isn't affected by that, and this is really a blowout. There's obviously probably some seasonal effects in there, probably some effects from the pandemic lingering in terms of the seasonal adjustments that BLS makes.
About $300 so far, so it's good.
That, American companies are not at this point feeling the
Gonna bounce. It's on that heavy support. Look at that.
Hospitality seems to be the big
RSI is 9. Look at that. This is beautiful. Just gotta wait. Just gotta wait.
And restaurants have been desperate to try to find people, so it looks like they are getting some people coming off the sidelines.
To try to understand the narrative behind this, Ellen Zentner was saying that perhaps wages are coming down more quickly than people had previously expected because there isn't as much churn in the labor market, the job switchers that push wages and wage gains higher. How much is that sort of masking the underlying strength that is going to be in wages for longer, even if we're not seeing it in the same kind
NAS
of
dropped down, so everything dropped basically. Because we're looking at
depend on the composition of the labor force and who's getting the jobs.
Look at that, 517k, crazy, wasn't it? the result way off. Look at that, 185, 517.
Does it mean that restaurants are paying more? I'll have to take a look.
And what were the wages as well? Wages were 400.
We're getting
Wow.
to the point now where companies may not have to offer that kind of thing. The only point I would make is that Tom Brady is a job switcher, not a. He didn't retire to switch jobs for a lot more money. So Lisa's point holds.
His wages skew the number. Let's be clear.
I was going to say he moves GDP.
Mike McKee, thank you. That is a monster upside surprise. 517,000. The only big economist on Wall Street that came anywhere near was Citi and Andrew Hollenhorst, a little north of 300k. Neil Dutta looked for an upside surprise. Well, here it is. This is what Citi said earlier this week. Powell's hopefulness must now confront the data. The dovish market reaction to Chairman Powell's relative.
Well, happy with that. About 300, that will do.
Inflation will continue to cool faster.
Now it's going to wait for the buys, wait to catch some of this come back to me.
Tom, here's a question for you.
There was the level, you see, look at that, you see it blew through that level. That was the level I said,
News conference with the
1902.
Any different?
Would have been different. Yeah, I think so. I think that what I see here, John, it's so important, with immense respect to how Mike McKee owns this story, is you wonder, does the rest of the world begin to trust the data if so many people are getting this wrong?
Have we got the perfect
This goes back
to
Jack Welch and his criticisms of Washington economic data, the late great Jack Welch, and you just wonder, do you trust the data? Why don't you bring in the optimist?
Neil Dutta, the head of US economic research at Renaissance Macro. Neil, are you seated or are you running around the room?
I just got back to my seat. Look, Tom, I trust a lot. Just going to Tom's point, I think for your audience, it's not about trusting the data. It's about trusting the people interpreting the data. Just in the same way political polls, right? I mean, the polls are off. No, the polls aren't really off. What's off is the people's interpretation of those polls. And that's what's going on here. I mean, keep an eye on part-time employment, part-time employed for economic reasons. Anyone who talks about that, it's a tell, because it went up.
Neil, just because of time, I want to go on this. I think it's absolutely historic here. I'm gonna fold in. There's other names as well, folks. Neil Dutta, along with great Jim Glassman at J.P. Morgan, with his decades of study of the labor economy. He owned the study of teenage employment years ago. And John just mentions Neil Hollenhorst over at Citigroup, who came within the vicinity here.
It's going to curl up, look. Let's see if we can.
About the fabric of American labor,
this way you should be putting buys in.
Us in the face with large parts of America with 2 and 3.0% unemployment. Why are we
There's
getting
another
this
60,
so
70 there, just got.
Well, I think it starts with, the underlying economic momentum in the country, which is picking up. I mean, it could well be that, conditions are picking up, employers...
It's a nice, look at that, nice pullback, beautiful.
For things to be slowing down, now they find themselves having to play catch up to that stronger economic growth. I mean, look, the underlying rate of employment is not 520,000. I mean, that is true, but it's probably higher than where the consensus believes. And given what we know about the trajectory going forward, there's risk that employment will remain strong. I mean, if you're talking about 200,000, let's say
some more there.
It's half the rate. Let's say that's the real number, half the rate of what we got today. So it's 250,000. That's more than enough to continue pushing the unemployment rate down over time.
Yeah, brilliant. They're all hitting.
And
Go on, push up.
Look, I mean, I've said this. The onus is on the economic.
Set my target now on just 60.
Frankly, I don't
increase it to 100 pips.
This is going to really change the Fed's calculus. I mean, guys, it's not like they're going to come out and say, "Oh, we got to go back to 50." All they can do at this point is just sort of extend out the 25s.
But Neil, how much are we looking at people who are getting?
Let's see, it's going to push down and reject back up again. Let's look on the bigger chart.
For 3 of these jobs that have been created.
Is it going to come back, like we say, back up to that level?
Share of employment. That's in the household data. I haven't looked at that yet, but it doesn't look to be abnormal. And look, I mean, if you don't believe the BLS, what about consumers? Look at what consumers are telling you about the jobs market, okay? The labor differential from the conference report, also a January data point, that was out earlier this week. I believe it rose to a 3-month high. and it's at a very, very strong level. Certainly, you know, more or less where it was.
So they said the target was 1888, and it's getting there. Look, not 1890. So it was right. Whoever called out 1888 was pretty much spot on.
Drawing on research from the New York Fed, consumers have a habit of spotting changes in their own local economies before the data, because they know the places that are, you know, putting up help wanted signs. They know the places that are handing out pink slips, and they see it before, you know, the survey collectors of the BLS do. And so, you know, consumers
Crazy.
are telling you that the
How they get
labor
it so
market is
wrong,
fine,
though. Don't understand that.
And that unemployment is low. So if you don't want to take the BLS's word for it, maybe we can just take the American consumer's word for it.
Neil, get on the phone
I
and
see
tell
this
some people I
every
told you
month.
so. Neil Delta there of Renaissance Macro. Fantastic.
So
to
this
catch
has
up with
been
Neil.
one of the
Okay,
widest
he told us there's your upside
by
surprise.
far in a while.
There's the upside
Yeah.
surprise, and as you go into your hour, John, I go into radio, is, well, I really want to emphasize it with the...
I thought it might have pushed up off that resistance, but it's such a big result, like you say. It's dropping all the way back down to that. We'll see if we get a pullback on this.
Are, John, still sitting above the 2 standard deviation trend of the January explosion. I thought we'd pull back more given these stunning numbers. No, we have not.
Do you take comfort from the fact that wages didn't accelerate in the way that maybe you might have guessed?
Drops
if
all
wages
around,
stayed
yeah,
at
that's for
17
sure.
and unemployment dropped to 3.4%?
I'm not going to give my opinion on this. Nobody cares. But the answer is it is an inflation dynamic and a growth dynamic. And the Dutta optimist, the Glassman optimist, maybe Hollenhorst is going to join that group. I don't want to speak for him or Steve Whiting yet.
Sure.
But the bottom line is, do we have a growth misestimation that you mix into March and April?
I wonder how different that news conference would have been with Chairman Powell. Coming up in the next hour, looking forward to this. Mohammed Al-Aaron of Queen's College, Cambridge, Rick Reeder of
So now we wait.
Jack Moroso of iCapital, Mike Collins of PGIM Fixed Income, and at 9:30 Eastern Time, we'll catch up with Section which I imagine have a little bit of a spring in his step, Tom, at the start of that conversation.
This is a social statement here, and Mike nailed it absolutely. You know, the consensus has a view, and as Dutta said, they have not gotten this right for whatever reason. There's no other way to put it. Let's do this. We're going to keep driving. Do you have one insight quickly? Mike McKee, one insight here before Jeff Rosenberg.
Big change in service industry jobs. The service industry jobs leading the way with 378,000 jobs for the month. So we're seeing the jobs created or picked up in the area that people are looking for. And also the wage numbers were revised for December to up to an 0.4% and 4.6%. So the drop in the average hourly earnings is even greater than just what appears off the surface.
We'll save it for another conversation. And productivity and unit labor costs may be suggesting a better growth picture for the American economy. Jeffrey Rosenberg joins us right now. He's portfolio manager, systematic multi-strategy at BlackRock. Jeff Rosenberg, does this adjust a fixed income view of BlackRock?
Yeah, you have to understand this is a big pushback to the slowing, and it's a reminder of what Powell tried to say to the market, though the market wasn't listening, that their main concern is they're not yet seeing the impact of their tightening in the labor markets. Yeah. And so this is a very clear message and a really kind of important warning that perhaps the interest rate sensitivity, put housing to the side, put the interest rate sensitivity of the economy to the Fed's tightening to date. Yes, there are long and variable lags, but we haven't really seen that degree of tightening. And when you take the financial conditions easing, the combined is perhaps what we're seeing here is the inability of the Fed to really get to its goal, which is to rein in the inflation pressures from a market. Powell said it again on Wednesday. It's still a labor market that is too hot.
Given that we are not seeing wages, Jeff, increase to the degree that some people might expect with such a headline blowout number, do you take comfort from that, or do you disregard that as a compositional effect of what jobs are getting created right now?
Yeah, the AHE number in
what we found when we started the Bloomberg Media Initiative Africa Financial Journalism Training Program
GDP, and you've got probably the best measure, the Atlanta Fed wage tracker. At least those latter two are still pointing to a
still dropping. It's going to hit this 18. It was great. Whoever said 1888 was absolutely spot on. Perfect.
To the Fed. Again, Powell was explicit when he said that earlier this week. The market wasn't listening. This report is a reminder that the hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
How would you play this then, Jeff? If you really trust the headline number more than you trust the wage number, why would you buy 10-year treasuries where they are if you believe that this Fed could be that far behind the curve maybe later in the year before it's apparent?
Well, it's a good question, Lisa, and you asked about 10-year treasuries, and I think you have to be a bit cautious here on the degree to which we've seen the rally in back-end yields, and you know, you don't have to buy those yields here. You can buy the shorter end of the market. The curve is at a historic level of inversion, and I think there's more vulnerability as a result of that. And from today's report and what we're seeing, not just from today, but for a long time in the data, the degree of tightness in the labor market may really challenge the ability of the Fed to deliver that pivot that the bond market's pricing in for the second half of the year.
Yeah, Jeff, it's a little bit off your remit, but I'm going to go there because I know Alan Meltzer and Marvin Goodfriend beat it into you at Carnegie Mellon. And that is, I wanted you to link in here the shock of 517,000 and the 48 other numbers that indicate this job boom that some few have called for, and the Biden stimulus. It just seems, are we underestimating, Jeff, tranche one? Maybe this is for Glenn Hubbard's coming up as well. Are we underestimating, Jeff Rosenberg, tranche one, tranche two, and tranche three, which can be summed up, as Blanchard says, of the Biden stimulus? Is that what we're getting wrong?
Well, what we're getting wrong and where the confusion is at is a tremendous distortion in the economy from COVID, both the COVID impact and the COVID stimulus. And so we're seeing the backside of that. And really what you take out of today's report is really the strength in services. And this is the handoff from the goods economy to the services economy. But we're also seeing those distortions in our read of inflation. The deflation that we're seeing from the goods side is pushing down the headline and the core measures of inflation. It's making it look like we've made a lot better progress. Again, Powell talked about this on Wednesday when he pushed back against the market inflation forecast to highlight that we shouldn't expect that goods deflation to persist, and you're going to start to see some of that come out. So this confusion from COVID and the fiscal stimulus is part of that. Is also
let's flip to US 30 now.
Surprise numbers that Mike McKee highlighted.
Let's have a look on US 30.
Side of the economy, highlighting the transition.
Leave gold alone now. Get ready for the open.
Jeff Rosenberg, thank you so much. Particularly thank you through this historic week. Mike McKee,
yeah, US 30 dropped nice as well. Like, it pulled back a little bit, dropped again. Usual. It's ready to come pop back in this zone, as you can see.
Adjustment factor for the month of January this year, and on a non-seasonally adjusted basis, the economy lost 2,505,000 jobs. Last year, 2,420,000 in the month of January, but it was revised seasonally adjusted to 364. This year, 517. So an additional 200,000 jobs, basically, from seasonal adjustment numbers in this, and as we thought, this may be a hangover from the COVID pandemic years.
We need to have a cross back up before we take a buy on the TDI and a cross out of the RSI bottom zone. So we sit tight. We're not going to join on this sell.
Than the market, and that to me is really interesting. Basically talking about how this is really confirming what they see.
My whipsaw on it. We got S&P futures down -50, but the 2-year
yield everything's dropped. Well done.
Considering 3.99.
There's the NAS. I mean, pretty much everything looks the same, doesn't it? You just got to pick the one you want to catch. NAS looks further away from coming back than any of the others, to be honest with you.
Showing the adjustments. It is a perfect guest at the perfect time. He was so much involved with the rebuilding of Columbia Business School. As we
I'm going to change this to NAS.
Of Columbia Business School the other day. He is Glenn Hubbard, director of Columbia's.
So just caught enough pullbacks for it just continue dropping. That's what you've got to do. Just quick in, out. And now there'll be bigger pullbacks arrive. That you can see that we're out of the zones here. Look. So NAS is going to come back.
Of the microcosm, the initiative, the way we go out on a micro basis and find growth in America that pushes against traditional caution, traditional gloom. You've owned the high ground on that for decades. Are we underestimating the American business spirit?
Let's put line mark
We are, Tom,
where we're going to join on the
as
open.
I said before, we're underestimating how hard it is to forecast the recovery from COVID as we change in the mix of consuming goods and services, how firms adjust, how industries adjust. I thought we would see an upside surprise, nothing like this, I confess, but it tells me the jobs market is much more robust than markets had thought, and certainly a worry for the Federal Reserve.
Yeah.
Hey, look, Glenn, at the fiscal stimulus of this, and let's go to your public.
It surprised everybody, hence the drop, because that means there's probably going to be, you know, maybe an interest rate rise.
Knows the math. Olivier Blanchard calls this the Biden stimulus. Are we still witnessing stimulus effect that leads to these shock numbers?
I think we're witnessing two things. One is the hangover from excessive aggregate demand stimulus, so I agree with that. But we're also seeing a lot of adjustment as the economy comes out of the COVID pandemic. The goods boom, and now our recovery in services, which are very labor intensive. So I think when people forecast jobs, they have to do so at a more micro level, given both of those factors. And I think the job market's likely to remain hot, posing a real challenge for the Fed. Remember, the JOLTS data were pointing in the same direction.
I'm just thinking about what Alan Ruskin over at Deutsche Bank said in response to this jobs number, saying, more broadly, one has to think in terms of higher equilibrium rates in this cycle, given very unique labor market resilience, and therefore less expenditure sensitivity to rates. Glenn, how high do neutral rates have to go if this labor market is as strong as it seems?
Well, keep in mind, while the Fed has adjusted, one could hardly describe monetary policy as overly restrictive, given where inflation is. So I think there are two challenges for the Fed. One is figuring out how high, and I agree the Fed's not likely to revert to very large rate increases, so more gradual rate increases, but probably into the fives. But it may have to hold it for longer than market participants think. The Fed, of course, has been signaling that, but the market doesn't believe it.
Do you think that this kind of strong data makes the idea of a soft landing more likely or less likely because of how long the Fed will have to hold rates high?
A nice support look.
Economists answer both. It could make it more likely in the sense that we obviously have a very robust underlying economy, giving the Fed some.
This is what I mean. You can watch the pattern. You had that drop, the pullback, which we caught, and then the continuation. And now slow climb back to probably where about, you know, where we started. So about here, look, US 30 and gold, you pretty much just take your pick. But we'll wait for the open, because I think the open will probably push it further. It'll be manipulation and go up higher. We'll see. Let's say again, we're not going to assume, we'll just jump in when we see the move. And we'll make another cheeky brew. Yeah, look, it's found some nice support.
Well, let me start longer terms.
NAS is the same, so we'll just stick and watch this. We'll see where it's sat, whether it gets to the open, where the CCIs are, the TDI is.
Recovery from COVID is leading to some reallocations that may raise productivity. That said, of course, we've seen a lot of productivity fluctuations, positive and negative, in recent years, and one swallow doesn't a spring make.
Glenn, we're talking a lot about trying to understand a very uncertain economic moment as the world recovers from a pandemic. There's a larger question that the Fed has to deal with as well, which is what is the implication of looser financial conditions and getting them further away from their goal of an ongoing disinflation? We've heard from a number of wonderful economists this morning saying it doesn't really matter at this point because of all the tightening from last year. Do you agree?
Well, again, I'm going to have to equivocate in standard econ way. Milton Friedman taught us years ago about long and variable lags of monetary policy, so there's reason to be cautious, as that view suggests. That said, there's a lot of momentum in the economy, and the way to tighten financial conditions is to tighten financial conditions. And so I think the Fed still has more work to do than the markets think.
Do you still think that this Federal Reserve should go above 5% and decidedly so?
I do think so. And thought so before this week.
Glenn, one final question here. We've got just a stream of news this morning, And I just want you to talk to me about the return of the risk-free rate. You got the chalk in your hand like Professor Joseph Cohen up at Columbia Business School, and you got a lot of bright young people that have never known actual cost of money. What do you tell them about this new world that's the old world you and I and Abby used to know?
Well, I think it's a matter of reminding people of basic discounted cash flow math that's whipsawing technology prices, stock prices, whipsawing prices of other goods producing sectors as well. And then also that higher returns for savers can be a good thing on the other side. So I think we're learning that risk-free rates in equilibrium aren't zero in an economy that's growing.
Very good. Glenn Hubbard, thank you so much. We're going to go to Ira Jury, Glenn Hubbard with Columbia, and of course, okay, fine. Thank you for that, Matt. We've got huge news streaming, and we're going to talk about this with our balloon expert, Lisa Abramowitz, joining us now from Balloon Central. These are stunning headlines, and these sort of allude, Lisa, to the mystery we're talking about. China says balloon is for civil use, climate research. Pick it up from there. Regretful.
So, from the Chinese foreign minister, they released a statement after we spoke all morning, and a lot of people were talking about that balloon over the skies in Montana that was a surveillance balloon. That was the accusation from the United States. China responding and saying it was regretful that the airship entered U.S. air due to a force majeure, saying that it was for civil use, as you said, in climate research. Again, how does this dovetail into Tony Blinken's expected trip there? He was expected to arrive on Monday. They have yet to make a decision about whether he will go. Just to understand this swirling drama, it really highlights the tense moment of just not making this relationship worse, let alone making it better.
I think it's an opportunity, and if we know what they know and they know what we know, they know that we know, etc. Did you get all that? And the answer is this may be comedy or mistake or force majeure, which is, I'm going to say, is a legal phrase, and unusual.
The importance of having COP in Egypt brings about the importance of having Africa as part of the transition.
Our region can play a very important role bridging the gap between the North and the South and playing an enabling role in this dialogue.
That many would say is fractured. Is it an opportunity at the end of the day?
What, the balloon?
The balloon. Is it an opportunity?
I don't think it's a balloon opportunity. I think that this was either way. Perhaps it was a trial balloon, as we heard from Anne-Marie, to sort of test what the U.S. response would be. Perhaps it was just a mistake. Perhaps it was actual surveillance. Either way, it just highlights the fraught nature that suddenly this is the top news, is a balloon over the skies of Montana, potentially from China, because they're already potentially surveilling different things. This is about
you can see it's just starting a slow grind. This is what happens after NFP. We get this 30 minutes of doing nothing until the open again, so it's fine. We'll just hang on.
Hong Kong radio and television there on the China trip of the Secretary of State. We've got a little more time. You got the way this
China regretful the airship entered
next to me, and he has triple top
due to force majeure. I like it.
Bramo's got Ted Williams 2010 eyesight, and McKeno's I'm blind as a bat. So
what's Naz doing?
Secrets here, and I can never see him. What do you see right now?
Back below the 200.
Please tell the special prosecutor. Give you one more interesting.
It's back below the 200 now.
Labor force went up by 886,000, and that is adjusting for the changes on a monthly basis by the BLS this month. So massive number of people's coming into the labor force, which tells you something about why jobless claims are so low.
Hold on a second. This is really important. Is this confirmation of what people were hoping, who are all called overly optimistic, that you would see basically all the people who were on the sidelines after the pandemic flood back to the labor market in the face of higher inflation, basically reducing unemployment further, but allowing wages to not rise that much? I mean, is this basically confirmation of that?
Could be. It's kind of hard to tell because at this point, it's not a month you would expect that to happen. I mean, historically, people get let go in January who were temporary workers, and the weather is lousy. And you would think that maybe in the summertime when kids get out of school and go to looking for part-time jobs. So to have that kind of number in January is usually the thing you would get if there was a rebound.
Yeah, I think next time I'll set the target a bit less. That was good. Well, I could have got more if it set my target a bit less, but
It's just amazing. Michael McKee, thank you so much. World-class effort there. And
US 30 again. Look, just going to range around on this level here until the open. So
Fantastic. And
guest
put
quality
together.
today, the range of this debate is something we'll fold into next week. And yes, on to Valentine's Day in the inflation report, futures at -51. I'm going to call it a resilient stock market after what we've seen. Thank you for joining us. Bloomberg Surveillance.
a resilient stock market. Everything's crashed. What's he on about? I love it. Hey, I like it. Future slide look as blowout January DOGE data. So for me, you know, that everyone's going to be selling, so I'm going to be looking to buy, like I say.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan.
The Open.
From New York, coming up, a monster month of payrolls gains, just as investors look for the chair to hit pause, and weak tech results colliding with a monster rally. We begin with the big issue. It's Jobs Day in America.
Yep.
I mean, nothing beats the payroll reports.
Look at the labor market.
520,000.
We're still looking at an incredibly tight labor market.
The onus is on the economic bears.
In terms of actually showing some of these cracks, getting that last little bit of inflation wrung out is going to be the hardest.
Part of it is wages, and we're going to keep a very, very close eye on that.
Last month was 223, which was a bit lower than the month before, which was a bit lower than the month before that.
But I also think we need to keep a close eye on the services data.
There is altitude to lose before I think the Fed gets really worried about the state of the jobs market.
The risks in the US is that the labor market does stay a bit stronger.
We're seeing the Fed trying to keep its optionality open.
All they can do at this point is just sort of extend out the 25s.
Joining us now to discuss, Mohammed Al-Aaron of Bloomberg Opinion and Queen's College, Cambridge, alongside BlackRock's Rick Reader. Gents, to the both of you, thank you for being with us. Mohammed, I've just got to say, wow. You've had 31 minutes to go over this one. Your reaction?
It's a three-part reaction. One, wow, stunning, awesome, great for the economy. Two, there's a bit of a puzzle. And three, there's a hope. So the stunning bit is the 517,000 job creation. You know, the top estimate was 300,000. This is way out of the league, and this is really, really good news for the economy. As is an unemployment rate down. We haven't seen this level for 4 decades. That's all great. The bit of the wage growth came in line at 0.3, but the hope, John, is significantly more people entered the labor force. You've heard me say over and over again, it's the supply side that can save us in terms of avoiding bad outcomes. And it's good to see the labor force expand, labor force participation going up, employment to population going up. That's all good news.
Rick Reader, unemployment 3.4%, the lowest since May 1969. Your thoughts?
I mean, I think it's impressive. I mean, how many months are people talking about we're going to recession, deep recession? Listen, I mean, we're in pretty good shape here in terms of where employment is. And by the way, you think about the average hourly work week, what the work week ended up being. I mean, you talk about real income into the economy. I think it's impressive. You know, we think, went through the data over the last couple of weeks. There's still a dearth of people for the leisure, healthcare, education, accommodations, hotel, restaurant. We still think you're over 800,000 jobs shy of where you need to be on a trend level. So you're filling those jobs. And by the way, it's good for the economy because these are generally lower wage jobs. You're improving net disposable income.
We're about to get crossed up on that.
It's a good thing. I mean, obviously there's pressure to solve it. It does. But gosh, I actually...
Yeah, just come to a standstill at the moment. Everything's pretty much on a standstill. Look, pulling back up slowly. There's the level. Look.
On the S&P 500. 200 in the bond market yields higher.
It's going to dip down again. Yeah, when this is high, it's going to dip down.
22 on a 10-year up 10 basis points to about 349. Mohammed, the PMI, the ISM is still sub 50, we'll see. And I wonder what you put more weight on, that or this labour market.
So John, that's what makes it really, really difficult. You could have also said layoffs, okay, which are going to be reflected in the numbers, in the actual numbers that are measured down the road. It's really difficult. I tell you, I
just look, if you took that cross before the news, that cross on NAS happened I think two candles before the news.
Yes, look.
Because the last thing
Man,
that we've seen is destroying the labor market.
you could have had a cross there and got the buy. Nothing there, that would have been a loss. But you could have got that one and then that one there.
Not right now, and not in that jobs report. Mike McKee joins us now for more. Hey, Mike.
Well, John, it is a shocking number, as you guys have been talking about. 517,000 jobs were created in the month of January. Way, way, way above what anybody expected. But even more interesting, perhaps, is the fact that the unemployment rate falls to 3.4%. You ask why jobless claims are not going up? That's probably why. The participation rate rises as well. And look at average hourly earnings. Despite all the good news, they fade a little bit. The December number moved up by 0.1% on a month-over-month basis. And so the drop to a 0.3 move brings us down to 4.4%. We are moving in the right direction, at least as far as the Fed thinks. Now, the jobs, where they are and where they aren't, this is something I wanted to point out. We had a big drop in the total number of jobs created in the household survey, and on a non-seasonally adjusted basis, we lose jobs. The seasonally adjusted, we end up with 517,000. But some experts on this, including Omar Sharif at Inflation Insights, saying that the numbers look pretty clean, that that kind of seasonal adjustment is not unfair. So that may not be part of the issue. Where the jobs are, service industry jobs. Rick was just talking about the need for so many people in the service industries. 397,000 jobs, 79,000 in healthcare and leisure and hospitality. They're still short, but they picked up 128,000. Here's an interesting one, though, construction. I mean, this is January. This is when there's snow and floods and stuff all across the nation, and we're getting 25,000 jobs. So let's take another quick look before I go here at the average hourly earnings, because I want to point out that what we're looking at is a number that is coming down towards what the Fed thinks is sustainable. 3 to 3.5%, they believe, is the kind of wage increases you can get without pushing inflation higher, and it's heading in that direction. Now, John, I got one thing I have to add here.
Sure.
This was a mistake I made in the last show, so we'll call it a surveillance correction.
Please do.
There's nothing wrong with the open here, but I had said 886,000 additional people in the labor force. That's the total number of people that had been put in by the revision. The actual number in the labor force fell by 5,000.
I've got skin in both shows, Mike.
Yeah.
Don't worry about it.
Well, you weren't there, so that
doesn't count.
Me, not you.
Mike McKee, thank you, buddy. As always, Rick Reeder, the Fed Chair, Jay Powell. If he had this labour market report with him on Wednesday, would that news conference have been much different?
So it's a good question. Listen, I mean, it's a pretty robust number. Do you have to put another hike, another 25 onto what the Fed does from here? Potentially, but I go back to if inflation, and by the way, you can predict. I mean, we still think when you look at where inflation is going to get to over by the mid-year, we think you're going to get headline PCE down to 2.9, core is going to get down close to 3. By the end of the year, you're going to keep decelerating. You look at used cars, you look at some of the commodity prices. So we think inflation is coming down. And again, I don't think that the Fed, if you have a dynamic where you're not getting accelerating inflation, some of those exogenous shocks, supply chains coming down, listen, I think we're still getting close to the Fed pausing. Do we have to go another 25 after this report? Maybe, but I think the key is rate volatility relative to where we've been is coming down, which I think is a really big deal.
Mohammed, I'll come to you on a similar theme. Is the chairman of this Federal Reserve on the brink of pulling back maybe a little bit prematurely?
We'll see. John, my view, and I put it in a Bloomberg Opinion article, is they should have done 50 and then stopped. And why? Because this is a really good time to get the rate hikes out of the way. It seems that I'm less optimistic then wicked.
See, was gold the same? So we look at gold as well. Yeah, gold was the same. Look, it had a cross down. It's like 15 minutes before.
At some stage, you know, prices can't go down forever. That's going to stop. We have services inflation where the balance of risk is on the upside, and these are less sensitive to the interest rate tool. So when I look at that, I worry a little bit that we may be too optimistic about the path for future inflation, and therefore
there was a drop of 1,000, 100, a drop of 200, 300. Look at that, 300 pips drop on gold. Crazy.
wouldn't have let the market run away as fast and as far as it did.
Well, Mohammed, let's pick up on that, because you used that word booming. This market, until this morning, has been booming year to date. The S&P 500 up around 9% year to date, the Nasdaq up by 17%. The chairman was asked about financial conditions. It was the penultimate question in the news conference, and I think a lot of people came out the other side scratching their heads. Let's go back over it. Take a listen to what the Fed chair had to
So
say
some nice
Wednesday
support.
about financial conditions.
So we're going to get a manipulation buy, or is everyone looking at the support and the market will crash down, taking everybody's? What usually happen is, like one DAX happened this morning, go up, trigger everyone's buys, and then bang, down she goes. So just be careful of that. Everyone's thinking it's going to sink, so futures slide, but it could be a catch out, like I say, that it'll push the price up, trigger, and then down we go, and then back up again. Or it could just go straight up. Like I say, I'm going to wait for the move. 15 minutes to go, 15, 60 minutes to go.
Which is a very narrow set of financial condition indicators. Mortgages, okay, things that very, very narrow set. And if defined by that very narrow set, then he is correct in what he said. However, that's not how monetary policy works. Monetary policy works through a much broader set of financial indicators. That's why the Bloomberg index, the Goldman Sachs index is much more holistic. And on those measures, we are as loose as we were last February. So, you know, it may be that they're looking at slim down. Now, slim down has become the practice at the Fed, just like inflation now is core services excluding housing, right?
Yep.
So it seems that we are in slim down mode when looking at certain data, which is understandable, but it's good, it's correct for the inflation data. I don't think it's correct for the financial conditions data.
Well, this starts to introduce the market question. Rick, was that a green light for you to buy risk?
See, that's what we called drop, and then here, bang, that was the pullback. That's what you wanted, and then out the trade.
Get out of the way and let the system do what it's going to do. I just want to re-emphasize one thing. The service sector jobs are lower income jobs. You're keeping net disposable income higher. That cohort, rent, energy, food, is what burdens at it. As long as income stays high, it took 20 years to get inflation to 2%. If we run a little higher, and by the way, I think we're going to settle a little higher in inflation than we have certainly over the last 10 or 20 years. But if that's the case, and we're closing the income gap and removing money from capital to labor, there's a lot of good stuff going on. So anyway, I just wanted to hit you because I think it's so critical. Anyway, back to your question. Listen, I think rate volatility is coming down. I think the Fed, I wish they did the 50 like Mohammed said, but let's say they do 25 and another 25. We're not doing 475s. You know, we said this on the show last month. Quality income, you still can lock in yields now. I mean, in the equity market, are multiples okay? The earnings season was just okay. Tech wasn't. Gosh, if you can buy quality income and lock in, you know, if you take some spread product and you get a 6 in quality income with rate volatility coming down, that's a pretty attractive environment. So, you know, I think this is one of those environments. The economy is slowing. I don't mean to say the economy is reaccelerating. The economy is slowing, but at a pretty good level. I like buying income and holding it. And over the next couple of years, rates will come down. And I like locking in some of these yields today. And again, you know, we're going to get some opportunity here. We certainly heard from the ECB. They've got a bit more to do. Although, like I say, I think we're getting close to where these central banks can, like Mohammed said, step back, watch the system recalibrate. I think that's a big deal.
Rick, you're not the only one on a fixed income call. You and I have gone back and forth on this. The fixed income is not what it was at the start of the year.
Futures sink, you see. Is it going to sink more? Are they going to catch everyone? Is everyone going to be putting their sells in and then it becomes a buy on the open? Okay? That's what you got to watch out for, isn't it?
Is very well taken. The you know, some of these spread sectors today.
What are you thinking? Hey, you thinking the same?
You know, high yield, I would argue, I can get.
Yeah.
Could be a nice little push up.
Yield for some of the high quality.
It's just a news push.
In some of the securitized markets today, so that's not that interesting. One of the things that I think is Europe now, because of
This is what happened with DAX this morning. It pushed up, triggered everyone's buys, and then bang, went all the way down.
Still pretty reasonable. And actually, emerging markets, you know,
It's quite, it's 50 pips to the top side there.
taking some emerging market, the yields, particularly in local rates, the yields are pretty attractive. But yes,
We'll probably get back to where it was.
In some of the areas we talked about a month ago, agency mortgages, investment
It's amazing when they always say that it's all costed and priced in, and obviously it's not. That result is crazy though. Like you say, that's one of the biggest misses. 400,000 difference. That's crazy, isn't it?
But I'm not surprised.
Well, we've seen it time and time again.
They just keep getting worse and worse at it. It's not like they're getting better.
Should you jump in?
Yeah.
Should you jump in?
So I looked at the arguments on both sides and concluded very much consistent with what Rick just said. If you're gonna jump in much more selectively. At the beginning of the year, it was
all that is a slight pullback on the 15th. It's not even a break of structure yet.
But we've come a long way, and now, as Rick correctly said, it's about greater selectivity. There are still opportunities out there, but they're not as generalized as they were a few weeks ago.
Given how robust the economy is, how resilient the labour market is, I'm going to keep that in mind when I read you out this quote from Mislav Matejka over at JP Morgan. He said Q1 in our view will likely mark a turning point as the fundamental confirmation for the next leg higher might not come, and instead markets could encounter an air pocket of weaker earnings and activity as they move through Q2 and Q3. Rick, Q2, Q3 feels like a lifetime away. Now I know you don't believe in the hard landing story. You're in the camp soft landing, have been for a while, but let's assume you are in the camp that it's a hard landing. And I call you up, Rick, and I say, look, I'm really worried about Q2, Q3. I think we're going to hit that air pocket. What do I do between now and then? Is there a window here for me to put money to work? What do you say back to those people?
So, I mean, well, first of all, I think January was one of the most extraordinary months I've seen in my career. The short covering rally in places that had been beaten down a month prior was pretty extraordinary. And by the way, I saw a stat that was the most incredible I've ever seen. The companies that missed outperformed on a price basis than the ones that actually beat earnings. This was a crazy.
Going to split, and again you see still US 30 going to hit that 50 EMA. Look at that drop. Going to pull back.
You know, persistence. I mean, look at healthcare, how much it underperformed. Parts of healthcare are not going to see the same.
TDI is high, look, as well, so this is going to drop on the 1 minute before it pushes up. Just got to watch it. About 10 minutes to go.
Short covering stuff that's rallied. I would do that. But listen, I think margin, part of why I think equities are just okay, is the margin compression is real. I don't think you're going to see a cataclysmic earnings dynamic, but in an economy that's okay, I think top line revenue is sort of meanders around, but I think you get margin compression, and so, you know, part of why I'd rather buy income, both debt and equity. I'd rather buy stable income much more so.
Mohammed, it is the ultimate pain trade for anyone who tried to short this market, to see it rip the way it has. And for some people who have missed out on these gains year to date, I want to go back to the phone call analogy. Mohammed, for the people that sat this out, who want you to get back in, have you ever experienced that in your career, Mohammed? I'm sure you have on several occasions over the decades. How do you respond to that when the market starts to move the way it is and more people start to get on board? The fear of missing out takes over. I know where we are this morning. Put that to one side. I want to talk about the year-to-date move. Mohammed, what do you say?
Oh, the inclination is for you to get sucked in. Look, there's nothing worse than underperforming a rising market, especially after you've had a tough year where the returns were negative. You know, your clients say, come on, I lost money last year, I had an opportunity to recoup some of it, and you weren't fully invested. So the people who are not fully invested, let alone the people who are short this market, it has been incredibly painful. And I suspect a lot of people have given up. It started with the short covering that Rick talked about, but it's gone beyond that. Look, it's really confusing. I remember 2 months ago you reporting on the consensus on Wall Street, and do you remember we were going to have a tough first part of the year and a good second part of the year? That was the consensus. Now it's turned upside down. We're going to have a good first part of the year, but it's going to get tougher in the second part of the year. And it just shows you that when you look at the three main macro drivers, growth, inflation, and policy, you can tell two-handed story for every single one of them, which means that the permutations that come out of that are very large. And that's where we are, John. And this is a really uncertain market. That's why at the end of the day, it's about if you end up being forced to make a mistake. No one wants to make a mistake. Which mistake can you live with? And that's not just a personal risk assessment, it's also a business assessment.
Hey, Mohammed, stay close. Equity futures right now down by 1.3%. We're about 11 minutes away from the opening bout. Just a stellar month of gains for this market and for the jobs market too. Yields are higher by 14 or 15 basis points on a 2-year. 425. AMH down in DC joining us for a conversation. Anne-Marie, I imagine that State of the Union gets edited just a little bit on the labour market.
Oh, it certainly does, Jonathan. How can anyone say that we're even close to a recession when you have 517,000 individuals being employed in the month of January, and on top of that, an employment rate we have not seen since 1969. So expect the president to come out today, declare some victory on the economic front. On top of that, Jonathan, later today, he will be in Philadelphia alongside Vice President Kamala Harris. Rare that you see these two individuals going out together outside of Washington, D.C., a joint event to talk about the economy. But obviously, this all points to a potential joint ticket once again for 2024.
On the same day you hear from the President in the State of the Union, February 7th, Fed Chair Jay Powell speaks in Washington at the Economic Club of Washington. AMH down in D.C., thank you. Mohammed, I want to come to you on that. Are you expecting anything different from the Fed Chairman next week than what you heard this week on Wednesday?
Really tough question, John. Really tough. And February 7th is going to be fascinating. I suspect he'd rather send other people to correct the market misunderstanding, if there is one, than himself. But it's going to be a really tricky appearance.
I want to come to you on this, Rick, in the bond market with yields higher by 14 basis points on a 2-year, on a 10-year by 12 basis points. Are we seeing some incoming information that challenges the bullish story for bonds, or is this an opportunity to pick up an extra 15 basis points of yield this morning?
Listen, I think this year is going to be about adding to yield into your portfolio. And I think, when you get opportunities, I think you're supposed to take advantage of. There's a couple of critical things. By the way, I don't think we're going to see a significant rate rally. I think people have gotten on board. Rates are coming down. The front end's pricing easing. I think that's aggressive. I think that the ability to carry and create this income makes for what will be a good year in fixed income. But John, I think there's one really critical thing here that you used to ask me all last year: how much cash do you have? How much cash do you have?
Yeah.
The reason why you run so much cash is because you can't hedge it. You can't use interest rates. You can't use equity volatility because volatility is too high. You can't use the dollar when it's a one-way. It doesn't move around. Now you have hedges. That's a really big deal. You can build income in your portfolio. If the economy slows, you'll see interest rates come down now for the first time. If you have a dynamic that equity volatility allows you to do put spreads, allows you to do some things in single name versus index. First time in a while you can hedge, means you can run less cash, have some income, and then build some hedges in. That's a completely different paradigm around managing risk and building portfolios than we were 6 months ago. The only thing you do 6 months ago is just sit on a lot of cash and hope that dulls the volatility of your portfolio.
So, Rick, let's make some news. I mean, you brought it up, not me. What's your cash position now relative to a couple of months ago?
It's much lower. It's much lower. I mean, we're building, we continue to build this quality income in the portfolio like we talked about the last couple of months. I mean, I think these yields, particularly, you don't have to go out to the 30-year, but you can build in
6-7 minutes to go, and you can see a lovely range forming. So we're going to get a move. We just don't have to which way. It will jump in.
And hedge it now. That's really interesting. So yes, we've run down the cash a lot, but I don't feel like we're hanging out there risk-wise because of the quality assets. The point you made earlier. Do you have to run a lot of high yield? Do you have to run a lot of loans? You have to run commercial real estate? Not really. You could build quality income and sleep at night.
Hey, Rick, Can we get Mohammed on board to keep coming back every Payrolls Friday? I always say this. He skips every other month.
If you want me back, John, if you want me back, you have to pick up on Anne-Marie's comment. You know, we haven't seen this unemployment rate since 1969. For Jets fans, that's a really consequential statement, because that's when we last won the Super Bowl. So there's hope for us, and there's hope for the Mets that won that year as well. So this is a very hopeful jobs report.
Better times, Mohammed. Fantastic to have you with us. A good friend of this program, a good friend of mine, alongside Rick Reader. Tremendous, the both of you, just absolutely brilliant. 6 or 7 minutes away from the opening bell. Coming up, big misses in big tech. Wedbush's Dan Ives.
Big misses, big tech.
Results from Apple, Amazon, and Alphabet Plus. Secretary Marty Walsh coming right up. Equities right here going into the opening bell about 25 minutes away and about 20 seconds. Equities down by 1.3% on the S&P. On the Nasdaq, we're down by 2 full percentage points. If we bring up the bond market, the moves we're seeing off the back of this payrolls report, absolutely phenomenal. Yields high by 13 or 14 basis points on a 2-year to about 424 on a 10-year, up 11 or 12 basis points to 351. Tremendous moves off the back of a blowout jobs report. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Ford to sell from earnings, highlighting the limited visibility into the automaker's supply base. That stock is down by 8%. Next up, RBC Capital downgrading Boeing to sector perform, warning that supply challenges will likely cap any upside to deliveries. That stock is negative 1 full percentage point. And finally, HSBC downgrading Meta to reduce $110 price target, expecting
everything pushing down, look.
Headwinds to weigh on future revenue. That stock is negative by about 2.8%. Just to round things out for you quickly, the moves we've had off the back of this payrolls report, tremendous. The number, if you're just tuning in, I don't know where you've been, the number 517,000 off the back of that. Equities lower by 1.4% on the S&P. Yields higher by 13 basis points on a 2-year to about 424. Coming up, the big misses in big tech. Wedbush's Dan Ives joins us on the disappointing results from Apple, Amazon, and Alphabet Plus. Labour Secretary Marty Walsh on a blowout jobs report just months away.
Get ready. Get ready for this manipulation move time.
This is what happened.
US 30 popping up now, look, already. So we're going to get a drop. Or is it going to push up to this level here? Look, that's what I was trying to say before. Triggering people's buys before dropping, eh? Crafty, crafty. You watch gold, I'll watch US 30.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who are, learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
27 seconds. Here we go.
Bloomberg's top political reporters and analysts live from the Bloomberg headquarters in Washington, D.C. As President Biden lays out his plans to tackle the war in Ukraine, Congress's debt limit standoff.
Pushed up, nice little manipulation there. 12 seconds. Let's see. Good luck, everybody. Here we go. Let's see what we can scalp.
30 p.m. Eastern, simulcast on television and radio, only on Bloomberg, your global business authority.
There's your buy, look, see, told you.
Let's get to that opening bound and finish up this week. What a move we've seen through the week. Big week of gains on course for that. Set to take a big bite out of it at the open. About 15 seconds away, we're down 2% on the Nasdaq 100. On the S&P 500, down about 1.2%. Taking a slice out of this market off the back of a monster upside surprise on payrolls. As the opening bound, switch at the board and get to the bond market.
Yay, got it. Got the sell, got the pullback. $50, that will do nicely. Beautiful. Very good, very good. Just waited for it to pull back there. You see, look, said the buyers were there to take everybody out of the game. Beautiful. There you go. Let's get to that line. Let's see if we can get in again. See, there's that spike. Look, say, told you. Manipulation. Oh.
The American economy. Equities down by a little more than 1% on the S&P, on the Nasdaq down by about 2%. One sector to watch at the open is big tech. Apple, Amazon, Alphabet reporting weaker than estimated results and derailing the Nasdaq's run at a bull market. Wedbush making the case for buying the dip in Apple, writing the following: Cupertino is a rock of Gibraltar tech story in a stormy macro environment.
Wait for that drop again, look.
This unique tech stalwart on China demand tailwinds and the gross margin expansion story. Dan, I'm pleased to say, joins us right now. So Dan, for most people, that was a downside
Messing
surprise.
around, look.
Why wasn't it that for you?
Yeah, I mean, because ultimately
this is
this
going to be a
quarter
pullback,
was
or
all
is Nat's about to
trying
recoup the
shore
losses?
additional lockdown.
See.
8 to 10 million iPhones. So I viewed the miss as sort of, you know, ultimately really saw through it.
Yeah, brilliant.
It's all about what the guidance
Got another 21. Got another $25 there on that little drop. Beautiful.
That's what Cook talked about. And even though revenues is coming down, gross margins, it's a 10-year.
What a spike on Nas, bro.
That shows the power here that they're going to ultimately see. It's a demand that continues to be.
Just watching US 30. Got another little pullback. So if this drop, the CI channel, look at that. Look at the TDI waiting for that cross down. Ooh.
That's pushing up off the support zone with a cross up.
Down 4%. Amazon's down by 5.8%. Dan, would you define Q1 then as a clean quarter to judge Apple by? Can we put you down on that one? This one's going to be a clean quarter and we can judge this stock.
Now it's going to push up again, you see. Wait till it hit this level here. Look at the bigger picture. Look, there's your neutral resistance. Look, there's your 4-hour resistance.
That story ultimately takes hold.
You watch this for manipulations. Perfect.
$200. I mean, that's our view on some of the parts, because it also, you go into this earnings season.
Nas, yeah, nice, same. Look, Nas exactly the same. See, everything's gone opposite to what the news says.
That's the narrative that really came across, and I think everyone was
Gone for the buys.
I think it's as underowned as I've seen.
Wait for it to hit this resistance level. Look at this, look. Pulling back. See, it's now back to, I told you, look, back to where it's getting back to where it nearly was, look. Where it started.
Surely when you go from acceleration to deceleration, that's a shift, and these companies might have to be valued differently. How are you changing?
Yeah, and look, and I think
all the way back, look.
Ultimately, the valuations were really reflecting massive decels. Instead, you've seen modest decels.
TDI looks well outside the bands now.
Months, then you start to see an acceleration, back into what I view as a more
Wait for it to
normalized
push up.
environment. You've seen the cost cutting. You got the Band-Aid ripped off. Ultimately, numbers are now hittable to beatable. And I think now it's set up where, you know, we thought going into this year, tech stocks would be up 20%. You talked about it.
You got it in a month.
You know, I ultimately believe no, but you look, I believe now we sit here end of the year, tech stocks are up 30%.
30%. There is a danger here, Dan, that all of this was just short covering. You mentioned the positioning story and that we're redefining the narrative based on the price action over the last month or so. As I say, deceleration in the cloud business elsewhere. What is in the fundamentals that you see that makes you think that we get a re-acceleration in those themes when the companies are telling me completely the opposite?
Well, look, I view it, we're in the early stages of a fourth.
See, resisted, came off that resistance, beautiful drop.
Paid $10 billion for ChatGPT. You look at what we're seeing in the cloud, only less than half the workloads are on the cloud. And I think we're now going to the next phase of technology trend. And even though we're seeing a slowdown in the macro, I think ultimately the cost cutting, that leads to the next cycle. And that's sort of our view for high quality tech. Profitless tech, some of that, they'll fall by the wayside. But also I think there's going to be a lot of M&A, a lot of activism. And right now, New York City cab drivers bearish.
Beautiful. Another $20.
I don't think that's the case anymore because we've had a massive run year to date. Dan Ives of Wedbush, sticking with the bullish call. It's working so far this year. Let's see if this changes. Do we actually get that re-acceleration Dan's looking for? Because the companies aren't looking for that. The equity market down about 1% on the S&P 500. We are about 4 minutes and 40 seconds into this session. On the Nasdaq, we're down about 1.8%. Just a fantastic jobs report. To see the jobs number come in at 517,000 and unemployment drop to 3.4%. That is truly, absolutely phenomenal. On Bloomberg TV and radio, I'm pleased to say that US Labour Secretary Marty Walsh joins us now from Washington. Now, Marty, did you have to edit your notes once you saw that jobs number in the last 24 hours?
Well, I looked at my economist and I said, you were way off today. You know, it was, you know, and I was on a call with some folks from the White House earlier, and they said, what do you think about the jobs report? I said, it was a good, straight jobs report. And Jared Bernstein made a joke. He said, you never change your tone. You know, it was a great report. I mean, when you look at areas that I think are really important, business grew, healthcare grew, education grew, and we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs of the economy and concerns about the economy. But right now,
yeah, NAS is pushed back up again. Look, you can see on the 1 minute.
I've said it to you now 2 months running. I mean, you've been right. I've tried to
pushing back to where it started.
Without that inflationary impulse, without wages picking up, we're seeing participation.
Everything's gone back. That's what I said. You see the markets do it time and time again. Go back.
I mean, I think we're still going to be assessing that and evaluating that for years to come. I think what's happening at this moment,
got green crossing below. Look on the TDI. Look, nice rejection.
Like you and me and all of us will be talking about down the road. I don't think there's really an answer other than, you know, the president did lay out an agenda in 2020 to get people back to work, and then in 2021 he laid out an agenda to
got another $20 there. I'll do nicely.
And I think we're living in a very different time right now, economic times, and you know, most economists or people who are business people won't really might not agree with what I'm about to say, but I just think that these are times we've never really.
So I was so high on this, just waiting to see.
We literally have to take this month to month to see, as long as we can move forward and
in and out,
avoid a recession and avoid a downturn in the economy, and try and create as many opportunities both for employers and employees in this country.
Well, the data is speaking to that right now, and the president has some fresh numbers to put into that State of the Union address next week. Secretary Walsh, I know you've got to run, so I want to work through a couple of issues with you. Here's one. You usually give us an update on what's happening on the West Coast with the dock workers.
Waiting for that resistance. Look, hitting that neutral resistance.
No, I mean, I've been in steady contact. This week I talked to all sides. They were able to work.
Well, high on the TDI. Look at it on the 1 minute.
They have not asked per se for me to come out and talk to them. I did go out January 2nd to sit down and talk to the
push up.
and some of the union guys out there, union people out there. They're moving along. Certainly, as I said to you a long time ago, I wish this negotiation was done, but there's a lot of issues out there that they want to go through. But so far, hopefully, we don't have anything that will hold this contract up. But certainly, it's something I'd like to get done sooner rather than later.
You've been pretty calm about it, and I often ask you, when does the red light start to flash? We're getting closer to that point for you.
through that 200 slight retest
there's an
and
issue
then
that I think is going to be
continuation
one
back
of those
up to
make or
where
break
we
issues.
started
Yeah.
this push down.
When we talked about rate, you know, the negotiations weren't really going on as they're moving forward. When sick time came up, paid sick time came up, I kind of knew that that was one of those red flashing problems. I haven't seen that yet in the ports.
Another $7 there, quick in and out.
You know, the way they work is a lot of the unions work.
Just scalping in and out. Just watching that move, look. Is it going to break that resistance and go higher?
Listen, you could change on a dime, obviously, but right now I feel good.
Secretary Walsh, usually Tom Keane and I like to talk about football, real football, the stuff that happens outside of the United States. I'm told you're a massive Bruins fan. Is that true?
I like the Bruins.
There's the push.
I like the Patriots. I like the Celtics, and I also like Man United.
Oh, you do as well.
Man United, what's he on about?
Because there's some interest in perhaps maybe you going to the NHL Players Association. Any truth to that, Secretary Walsh? There was a report from Politico this week.
I don't have any personal news to make today. Today I'm focused on a jobs report that is shown since President Biden has taken office. 12.1 million people have either gone back to work or
13.
the economy, and you know, certainly this is such an honor being Labor Secretary, and on a day like today I feel even better about it being able to be
all right.
That sounds like you've got some
Brilliant. There's another $10.
Watch price action in this candle.
Yeah, I'm watching it.
I think we can read between the lines there. It's going to catch up, sir, as always. The Labour Secretary there, Marty Walsh. Coming up, more data coming in after today's very, very hot jobs number.
Going for a break even there.
Could well be
Just push
that,
down.
you know,
Come on.
conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth.
That conversation still ahead, plus iCapital's Anastasia Amoroso, PGIM's Mike Collins joining us, and Mike McKee's going to run back to the studio too. That's next. This is Bloomberg.
Meeting that heavy resistance. Pushing down. Price back to where it was now, look, see?
Still got a little bit to go.
Top names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union.
So far, it's holding bullish.
Should cooperate, and that we should understand that there is
There's another $20 there.
respect for the individual rights of man, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
DPDHL
Nice
is
rejection.
a consistent message with its investments. The company spent 123 million euros to upgrade its logistics center at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity.
Look at the price action. Look at the, you see it looks lining up.
And said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed.
They don't want to let those gains slip away.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials.
Got 1 minute left still on this candle.
Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It could well be that, you know, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. Given what we know about the trajectory going forward, you know, there's risk that employment will remain strong.
Neil Dutter of Renaissance Macro, 517,000 in the jobs report, 3.4% the unemployment rate. You've got to go back to May 1969, and the equity market down 0.7% and trying to stage a comeback. The Nasdaq down by 1.2% in the bond market.
And we got another $12 there. That was really good.
On a 10-year up 10 basis points to 349. With us, I'm pleased to say, iCapital's Anastasia.
Beautiful. Look at that. You just have to wait for that TDI to cross. Look, TDI is now crossed. Look, wait for it to cross down on the 1 minute.
And then this morning, off the back of a massive
RSI is coming back into the zone. Let's just hang and wait.
So I imagine the data this morning backs that up.
Well, it certainly does. And John, I think I said it last time on Payrolls Friday that it was a soft landing type of a report. And this is yet again a soft landing type of a report because we're seeing phenomenal job creation. We're seeing job openings that are still at 11 million. And as a result, these layoffs are not resulting in higher unemployment numbers. So as long as consumers are gainfully employed, that's going to prop up the economy. And I guess the other silver lining is that the wage inflation, 4.4%, a little bit higher than expected in last month year over year, but it's still sort of holding in this 4% range. So that's the silver lining, John. But I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started and it's soon going to start in the services part of the economy. I think it challenges that view because if you have 11 million jobs out there and people are going to find jobs, that still creates some wage pressure, and 4% year-over-year wage growth is just not good enough for the Fed. So near term, I completely understand the market reaction, and frankly, we've come up a lot in a short period of time, so I'm not surprised to see this give.
Wait for that to push back up again. TDI is cross. Look, see, look at that. Yeah, beautiful. Look at it fighting.
It's going.
Look at the, you know, half a dozen or so last reports. The job growth is averaging.
We're right back to where we started, though. Look at that. You put a line right across that now. Look, now it's going to break. So let's wait.
Let's see what happens up around that 12,725 area. We've got a 4-hour resistance right there, but Nas's been known to blow smooth through, especially on these type of moves. So just watch that area, 12,725. I'm eyeing 12,900. But see what she does right here.
Got to break that 12.7, isn't it? Like you say.
For people, and you're seeing the movement in rates and stocks.
You know, it's still high. Look, we need the other CCI to come out, and then we'll get a pullback. But not at the moment. Look, we're going higher, like you say.
You said jobs are going up, inflation's going down. My economic plan is working. You'll hear from the president at 10:15 Eastern time, about 30 minutes from now. Mike, let's take the price action away. The market reaction to the payrolls report from now and 15 minutes.
Got to cross back. We need to cross down again.
When you look at that report this morning.
But the centre line is above 50, like you say, so we're still bullish, sorry. So just have to wait. Wait.
Yeah, I mean, we've already seen a deceleration in the wage growth, right, from the mid to high fives down into the kind of mid fours. And I think a lot of that is the mix shift, right? You're seeing
We're
all
just
the
now about to have a 820 cross. See if we can drag those MA back above that 200. We can. We're fixing to head back up 12.9 area.
Lower paying services jobs, Jonathan. So that naturally brings down the overall level of wages, which is good for the.
It's broke up above that now, and it's back to where we started. Look at that. We're above. This is what I said about the manipulation on the market. CCI is now high. Look, this is really good. That's what a TDI cross look. See, it's on US 30. There you go. You can see that it's broke now. The 200 moving average hitting this resistance, but it's above.
not a bad world for investors.
If you got that cross there, it looks perfect. 215. Look at that. 50 minutes before, it predicted the move. See?
Well, what now? I do think that at this very moment,
There was the drop, there was the pullback. There's NFP, there's the pushback. Well, we say it always does. It goes back, all the way back.
You see what I'm talking about? Whenever you get them, so you can get some good power moves whenever they're outside the bands, but the smoothest moves that you're going to get is, like I said, whenever you're slow and your fast MA are at the bottom of the band, inside the band, crossing up with your 50 above for a buy, and then at the top with your 50 below for the sell. It's just smooth like clockwork. Whenever you're outside those volatility bands, it can get sketchy and dicey. And typically, it continues in the direction that it's going for a little ways until it finally settles and gets back inside the bands. And then whenever you get that nice smooth cross, you get just beautiful moves to the upside or the downside depending.
Inflation, and maybe we're not, in fact, on the path to 2%. So that's the risk that I worry about, that the markets sort of need to price in near term. So the view is, yes, there are silver linings. Yes, there's reasons to be more constructive on stocks this year, but it's really difficult to see us go above 4,200 until we convincingly get rid of inflation.
Given what you just said about inflation and the backdrop and what may materialise later in the year, I'll get my words out. It's been a long morning. Anastasia, does that shape your view on what sector you want to be in? Would you fade the leadership in tech you've seen so far this year?
There's the rejection look of US 30 off that.
Sectors that we like, which I do like semiconductors, I like software, I like real estate. Now that they've run up, in the case of semiconductors, 15% or so year to date, I wouldn't tell you that now is the time to add to them right now. But as things pull back,
another quick $5.
You do want to buy are the ones that are well positioned for the Fed funds rate to peak and for inflation to sequentially come down. And that brings me to semis. I really like that space because valuations have been cut relative to last year. And semis are very highly correlated with manufacturing PMIs. Well, the PMI data went from 60 to now 46. So
there you go, look, back into the band, just as we said, look. Just went up a bit higher to catch people out before taking that drop, look, beautiful. There's your cross down.
So I think there's a lot supporting the sector, and especially the secular semis.
That's your profit taking.
It's not about PCs and smartphones, but it's about artificial intelligence, for example. So that's where I would focus within the markets right now. But I would do so once the semi stocks correct just a little here.
Mike Collins, that's equities. Let's finish on credit. High yield spreads have tightened so much, 386 basis points now, Mike. I asked this question of Rick Reeder earlier on. When you started the year, it was buy fixed income. It looked great. There were big yields. Is the same true now?
Yeah, Jonathan, I think in high quality bonds, to Rick's point, we're kind of in agreement with him on this one. There's so much value in high quality interest rates, high quality spreads, but I don't think you're getting paid enough yet to go down in quality aggressively, right? Yeah, the high yield market's yielding 8 and change, but you do lose some of that to defaults, and we know default rates are going to go up. These higher interest rates, as companies have to start refinancing their debt profiles, and consumers, right, and real estate investors, that is still going to bite. People talk about these lags of monetary policy, and I think the longer that funds rate stays around 5, it really does start to bite. So you're going to see more weakness later in the year. Yeah, maybe it's not the hard landing, and I've been in that kind of soft landing, mild recession camp all along, and it seems like that scenario is really playing out here. So it's not a disaster for high yield, but at these levels, it's not really attractive. But it's a year where you buy on the weakness. You kind of hope for spreads to widen, and you buy because now you have the Fed potentially behind you. To Rick's point again, last year you went from a year where the funds rate went from 0 to 5.
Yep.
That's a year where you kind of sell into rallies. This year, they have 500 basis points of capacity to support the economy if it does weaken. That's a really good position to be in.
Mike Collins, this was great, as always, alongside Anastasia Amoroso. To the both of you, thank you. Bit of news out of Washington. The Biden administration had been weighing whether to postpone or cancel an upcoming trip of Secretary Blinken to China, given the latest news over the last 24 hours that the US have been detecting a Chinese surveillance balloon over the United States. Getting some news just now, the US to postpone Blinken's visit to China over that spy balloon. So that's the latest news there.
Nice drop look, beautiful, worked well that. Coming back. Is it going to push back up again?
Saw that hit,
Rejected.
at about 8:30 Eastern time, retweeted it and said jobs are going up, inflation is going down, and my economic plan is working.
Very flattered. I guess you can credit the president because the president has to take the blame when things go bad. So, a lot of this has to do with the spirit of the American people, but he can grow today. John, we did have a little economic news while you were talking to Mike and Anastasia. The S&P Global U.S. Services PMI comes in a little higher, 46.8. The composite comes in at 46.8. Those are up 2 ticks. The next thing is ISM, top of the hour.
10 seconds, still holding bullish.
We've got 5 minutes for the news look. There we go, ISM. Last news of the day to trade. And then that's the end of the stream for today. Last trades of the day and week for me. We'll do some mentoring and teaching on Sunday night within our group, and then I'm away, but I'll still be trading on my laptop next week as and when, dipping in and out. Let's see if we can finish with another nice win.
Here in Houston for the past, I would say 20 some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist?
ISM PMI.
Yes, no question, this will persist.
It's all ranging, waiting for this news now. We've kind of recovered everything from NFP, so now we're back to normality. Look, back to normal.
As we age,
3 minutes to go.
more vulnerable to infectious diseases like RSV, and for millions of older adults exposed to it each year, solutions have evaded scientists for generations. At GSK, we believe we can change that. How? By uniting science, technology, and talent to get ahead of RSV.
Can trade gold on this as well, but I'm going to trade US 30 again. See if I can get a little bit. Just 12, $15 would be nice, that's all, just to make it a nice round even figure for profit for the day. That's all I need, just a small win. Two minutes to go. And what's it predicted to be? It's predicted to be 50, which is obviously good in employment. So yeah, we'll probably get a drop if that is the case, I reckon. The manufacturing PM, the non-manufacturing, the PMI will be 50.4, so we could get some sells here. Let's see. If we do get sells, it's going to be down to the KG line maybe. Just going for 7 pips, 70 points. I've got 1 minute 34 left.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting
40 seconds left.
And grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential.
15 seconds. Good luck, everybody. Let's see what we can bag. There's the result.
Bloomberg Wall Street Week live
3, 2, 1. There you go.
and on Bloomberg Television and Radio.
DOJ or other authorities.
Yay. Got a nice little $10 win there we did. Just on that drop. Perfect. Go in, it's wicks exposed. Let's try and go in again. Going to push down a bit more, look.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history. Mainly because of a human error that led Pepsi to print more winning caps than they planned.
Yay, we got $30. Oh, took an 83 cents loss on that. Damn. We got 744, 1571, 1158. So that was a nice end to the week. This ISM trade. So it was.
Nice little news manipulation right there.
So it'd be a sell, you see? Perfect.
Yep.
Beautiful spike down.
I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign.
It was nice because the result was better than expected, you see. There you go, it was higher. So that's why we got the little manipulation, as everyone will be saying, oh, better than expected, I'll put some buys in. And you get wiped out, as we know.
They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola.
Brilliant. Well, that's nice. Look at that. Here we go. Look on US. It's pushing down a bit more. I'm not going to get in again. Why? Because my CCI channel is kicking up. Look, as you can see, this one's mid-range, which means, you know, it's a small move. Danger. You need both of them to be outside, either top or bottom, to be a convincing move. The TDI is down the bottom, going to curl up. So, you know, you could just wait for a buy, to be honest with you. It could drop down a bit lower, but it's not worth the risk. We've got what we needed to get from the market, from NFP and from today. So nice win on the sales.
I think that might be the 200 reach and retest.
Yeah, see, it's ranging around, like you see, because you've got conflicting. You've got it wanting to sell, but you've got, you know, the momentum is people wanting to take profit and then buy. So you know, TDI crossed up. Look there, look, it's a fake out. You want to take in that again because nothing is outside the channels. So and it drops. We just caught that. So that was a nice little win. A double. US stocks are falling after big jobs news. See, means interest rates could still go higher, and that's why people ask why. It was good news, but that's why you've got to see the bigger picture. So yes, we're good. Great stuff. Right, let's have a quick recap. So yeah, look at that. So nice pullback off that news. NAS took a little bit of profit taking on the 1 minute and has pulled back up. They say we're heading for higher just in thinks on that. And US 30, as we've just seen, a nice little dip. Look at that new spike. I love these new spikes, you see. That's what it's all about. So keep watching that. Justin will keep watching gold. And yeah, we'll try and do some live streams when I'm back off my break next week after next. We'll try and do some late evening UK time, so kind of the last 2 hours of the US session, and see what scalping we can do in a different kind towards the end of the day as well. So again, hit the like button, subscribe if you haven't already subscribed to our little channel, and join us for more true scalping very, very soon. But thank you everyone for joining. Thanks for Justin for joining me as always.
Always.
The master of the strategy. And like I say, you go to the website www.mohawkforex.com if you want to join our group for a small fee and have us mentor you in the way of true scalping. We're always coming up with new ideas, new strategies, new systems, but we always base it around the 1 minute and the 5 minute kind of charts. So we're true scalpers, and that's what we kind of base everything on. So brill. All right, until the next live stream, trade safe all, happy NFP day, and we'll see you on the next one. Take care all.
Ciao.